this is a big thing. Just as I said, this is twice the size of North Rock. This is a pretty substantial failure of US regulation, and there will be a tendency to overreact to that. So you're absolutely right. That will stifle, that will crimp lending, and that will feed into an economy that was already losing some momentum. It's hard to say exactly where the economy was. So I stick with my call that the Fed have reached a limit in terms of interest rates. They'll certainly stop QT, and we will see lower rates for probably 50 basis points by the end of the year. What does it mean for markets? Well, I do think also this is probably a continuation of the peak in the dollar. I think the dollar has been trading softly for several months since the October highs. I think in a different interest rate environment where the US economy is decelerating, where there'll be recriminations perhaps on Capitol Hill, we know how fractious the political environment is, then I think that actually leads into a softer tone for the dollar. And actually, for investors, emerging markets tend to benefit in this environment where we see a different tone in the currencies and we see softer bond yields. 10-year bond yields are, say, around 360. I don't see any reason why 10-year bond yields can't by year-end be at 3%. And I think that is supportive, particularly of emerging market and European equities. The US picture is a little bit less clear. I mean, the excesses that we saw in this whole financial bubble in the last 2-3 years, most of those were concentrated in the US. They were concentrated in things like California, in Silicon Valley, in the tech sector, and hence there is a bit more air that could come out of that bubble. And we've seen, in this example, it could come out quite sharply. So we're not quite sure where other shoes are going to fall. I'm a little concerned about US assets generally. I think they have a little bit more work to do, a bit more wood to chop. But I think that the picture outside the US is actually quite positive in this very new world where we're seeing a peak in Fed rates and cuts by year end.
Stephen, if you're calling 3% on the 10-year yield by year-end, that still suggests that there could be a problem on the maturity profile of some of these bank balances, because effectively we've got this window now, this bank term funding program from the Fed, a loan window for 1 year, but it does suggest that you're going to see a massive flip on some of those longer duration bonds over the course of 1 year. Otherwise, we still have a problem, don't we, at the end of the day? The reality is, if you look at where the bond yield was, around 1% or less, back when a lot of these banks were rolling some of their exposures into the longer end of the curve, we're still sitting on enormous bond losses at some of these banks, aren't we?
We are. I mean, problems can go away. I mean, there you are. We had a FDIC limit of $215,000, and in theory, all the Silicon Valley Bank depositors above that limit should have been torched this morning. Well, guess what? They weren't. So, portfolios can be moved around, creative accountancy can be allowed, the Fed and other government bodies can take portfolios off banks' balance sheets. So, these problems will not come to the surface. These problems will be massaged away because at the end of the day, moral hazard rules. And that is my message, again, slightly longer term on a 2 to 3, 5 year view, is that, guess what? Inflation can't be slayed. The ability for the Fed and other central banks to tighten and tighten enough to really right-size the financial system has been shown up very, very abruptly here. So again, investors need to focus on being long-term holders of risk assets and equities, because that's the only protection against the long-term problem for this decade, which is that inflation is going to average 4 or 5%, in my opinion.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.